Good afternoon, students of taxation. So today's video, we're going to discuss income tax of a domestic corporation. Okay, so let's start. A domestic corporation, as defined or provided by the revised Corporation Code of the Philippines, are entities organized under such law. So there are two kinds of corporations under taxation for tax purposes. One is the ordinary corporation as defined by the Corporation Code of the Philippines. And the other one is what we call the one-person corporation, which is created under the Create Law. Okay? So we have already discussed the difference or the definition of these two corporations on our previous video, which is types of taxpayers. So kindly review our recorded lecture on that particular topic. So next, the term corporation does not include general professional partnership. So we have already discussed the definition of GPP. And under tax laws, under the point of view of income taxation, GPP is not considered as a corporation. So for the purpose of the computation of income taxes, individual partners of a GPP will be liable to pay their own separate income taxes after the distribution of their respective share in the profit of the general professional partnership. So these are partnerships uh, composed of individual practitioners or professionals. Second, we have a joint venture or consortium formed for the purpose of undertaking construction projects. Okay, so same is true. Joint venture is not considered as a corporation for tax purposes, since joint venture are just agreement between two entities, either an individual or corporation or a combination of both. Okay? Second is another joint venture for the purpose of petroleum, coal, geothermal, and other energy operations pursuant to an operating or consumption agreement under the service contract with the government. Okay, so same is true. These three mentioned entities are not considered as corporation under or for the purpose of income tax computation. Okay, so you can review the definition and separate discussion for this type of taxpayers on our recorded lecture on types of taxpayers. Okay, so next, this time we're going to discuss the different liabilities or tax liabilities of a domestic corporation. So a domestic corporation is liable to pay capital gains tax if there are onerous transfers of property under the name of the corporation. Since domestic corporations or corporations is considered a juridical personality, it is a personality separate and distinct from its stockholders. So this juridical personality has some rights like right to sue and to be sued, and a corporation also has the right to own properties. And of course, the disposition and any other power vested on holding such property. So the same rights is enjoyed by a corporation. The same rights with individuals are enjoyed by a juridical personality or a corporation. Okay, so if the corporation has a capital asset, like for example land and other shares and stocks, which is transferred through onerous transfer or sale to other person, that would be subjected to what we call capital gains tax. So we have already discussed that one on our previous video. Kindly review those recorded lectures. Second, we have final tax on passive income. So corporation can deposit its cash or any other cash equivalent to a bank, and if that deposit earns an interest, so of course a domestic corporation is also liable to pay or to be withheld with what we call final tax on passive income. So in our example, that's interest income. Okay, so we have already discussed that one on our previous recorded lectures. Letter C. So we have your regular corporate income tax, or what we call RCIT. And letter D, we have your minimum corporate income tax, or MCIT. So actually guys, your RCIT has the same tax base. Okay? So if we're going to pay both MCIT and RCIT, so of course it will constitute double taxation, and it will be unfavorable to the taxpayer. So in short, you either pay RCIT or MCIT, as the case may be. Okay? So let's proceed. Let's discuss in detail what are the things that we need to know with regards to regular corporate income tax and your minimum corporate income tax. So let's proceed. Your capital gains tax. First, the capital gains tax applies on sale at gain of shares of stocks of a domestic corporation not listed and traded in a local stock exchange held as capital asset. As I've said earlier, corporation is liable to pay capital gains tax if there are assets sold or transferred through onerous transfers. Okay? So the same with individual, a corporation is still liable to pay capital gains tax if the case applies or if the transaction A is present. Letter B, sale of real property. Example given, we have land, building, and anything attached to the soil with permanence, held as an investment, capital asset, sold whether at a gain or at a loss. So it is the same discussion with capital gains tax for individual. So same lang din sila, parehas lang guys. There's no difference. The only difference is the taxpayer is a corporation. Okay? So I would like to remind and to highlight that on letter B, sale of real property, the gain or the loss is irrelevant to the computation of capital gains tax. So it is a 6% final tax ang aton nga capital gains tax. Since the tax base for capital gains tax on real property is either the selling price or the fair market value, whichever is higher. So therefore, book value is irrelevant. So whether the result of the transaction is a gain or a loss, still a corporation will pay 6% capital gains tax. Tax on domestic corporation. Okay, on sale of shares of stocks of domestic corporation not listed and traded through a local stock exchange held as a capital asset. So this will be the subject for our capital gains tax, and its tax base would be on the net capital gains. Take note, net capital gains. Okay? So if the transaction happens to be a loss, so therefore there's no capital gains tax that the corporation will pay. So since the tax base is only on net capital gains. So the rate would be final tax of 15%. Final tax of 15%. The same with individual taxpayer. Next, illustration. On a sale by X corporation of shares of stocks of a domestic corporation not listed and traded in a local stock exchange held as an investment or capital asset at a capital gain of 80,000. How much was the capital gains tax? Okay? So using what we have discussed on the previous slide, the answer would be capital gains tax is equivalent to 80% multiplied by 15%. So the result will be 12%. So the shares of stocks, important things to remember, the shares of stocks are those of a domestic corporation. Take note, the shares of stock should be from a domestic corporation. Second, the shares of stocks are not listed and traded in a local stock exchange. So if the transaction happens within the stock market, so this computation is not applicable to that particular transaction. So this computation is only applicable for those shares of stocks of a domestic corporation which transferred through onerous transfer outside the Philippine Stock Exchange or Philippine stock market. Letter C, the sale of shares of stock should resulted a gain. Okay, so therefore, the selling price and the book value of the shares should be should result to a gain, or therefore the selling price is greater than the book value of the shares of stocks. In that case, the corporation will be subjected to a 15% capital gains tax on shares of stocks traded outside the Philippine Stock Exchange. Okay, next, tax on a domestic corporation. So letter B, on sale of land and or building held as an capital asset regardless of the location of the asset. Okay? So the tax base would be the gross selling price or the price agreed by the buyer and the seller or the current fair market value prevailing at the time of sale. So the value or the FMV or the fair market value at the time of sale, whichever is higher with the gross selling price, would be the tax base of our capital gains tax on sale of real property. So therefore, if you sold your property uh, less than the value or the book value or the cost of your property, so it will result into a loss. But the tax base of our 6% capital gains tax would be on the selling price or the fair market value, whichever is higher. So therefore, it is irrelevant. The cost of the property is irrelevant in the computation of capital gains tax. Whether you resulted in a gain or a loss, still you will pay a final tax of 6%. Okay? A final tax of 6%. Okay. Illustration. On sale of land and building in the Philippines held as an investment at a capital loss of 2 million on a selling price of 4,500,000 when the fair market value was 3,500,000. How much is the how much is the capital gains tax? Take note guys, the capital loss given which is 2 million is irrelevant in our computation. So we don't need this figure. We don't need this figure, the 2 million capital loss. What we need is the 4,500,000 fair market value, selling price I mean, and a 3,500,000 fair market value of the property. Okay, so all you have to do is to compare between the two figures. Whichever is higher would be your tax base. So in our case, the tax base would be 4,500,000 multiplied by the 6% capital gains tax rate that would give us a capital gains tax of 270,000. Okay? So, important things to remember. The tax base is the highest between the selling price and the zonal or assessor's value, which is the fair market value of the property. So, the fair market value of the property could either be zonal value or BIR zonal value or the city or municipality's assessor's value at the time of sale. Okay? So the capital loss is completely ignored in the computation. So guys, in actual practice, if you're going to sell your property, real property, you will be liable to pay a 6% capital gains tax, and there is an additional tax that will be paid by the seller of the real property, and that would be documentary stamp tax of 1.5%. Okay? That is for your information. For your information only, your in the onerous transfer of real properties, you will be liable to pay capital gains tax and documentary stamp tax of 1.5%. So if you ask somebody which is not knowledgeable with the actual rate, they will give you the rate of 7.5%. But actually, the capital gains tax is only 6%. The remaining 1.5% would be your documentary stamp tax. That's another tax type. Okay? That's another tax classification of documentary stamp tax. So, for your information. Thank you. Next, on another income that a corporation uh, has a possibility to earn is a dividend income from a domestic corporation. So don't be confused. In our previous discussion, it was gain on sale of shares of stocks. This time, it is a dividend income. Just in case that the shares of stocks held by our corporation is hold and held as an investment through earning dividend income. So the dividend income earned by the domestic corporation would be exempted. Okay, it would be exempted from income tax. Then your foreign sources under certain conditions or dividend income from outside sources should be exempted from the computation as well. Okay, next. This time, we're going to discuss your RCIT, MCIT, and OGIT. Okay? So, the subject would be gross or taxable income from all sources within and outside the Philippines. So, this will be the subject or the tax base of your RCIT, MCIT, and OGIT. So, let's discuss first RCIT. So, RCIT, it is the regular corporate income tax or RCIT. Sometimes it is called regular tax or RT, and sometimes it is called as normal tax or NT. Okay, so the rate would be, the current or the effective rate would be 20% or 25% of the corporation's taxable income. Okay, of the corporation's taxable income. Next, your minimum corporate income tax or MCIT. It is 1% of your gross income. 1% of the corporation's gross income. We will discuss that in detail later. Next, effective July 1, 2020 to June 30, 2034, the rate of your MCIT is 1%. Because prior to that date, prior to the effectivity of rate law and train law, the minimum corporate income tax is 2%. So, because of the implementation of two new laws, it was reduced to 1%. Next, we have your optional gross income tax. So, it is still 15% of gross income. During my time as student, it is already 15% of gross income. It is called optional because there are certain conditions that that the corporation should met or the situation should met before the grant of optional gross income tax. So if the corporation is liable to pay RCIT, so therefore the corporation will no longer liable to pay MCIT or GIT. And MCIT, if the corporation is liable to pay MCIT, it will not liable for RCIT or GIT. If the corporation is subjected to GIT, so RCIT and MCIT is disregarded. Okay, so RCIT and MCIT are all partners in crime. There are partners in every computation of a corporate income tax. For corporate income tax purposes, RCIT and MCIT are partners in crime. Okay, so you should both compute MCIT and RCIT. Okay, so let's discuss in detail the regular corporate income tax or RCIT. So it is effective on July 1, 2020 up to until 2027. Okay? So there are two rates for RCIT. One is 20%. So for a corporation to be liable for 20% RCIT, the corporation should meet this qualification. First, the total asset of the corporation, excluding land on which the business entity's office, plant, or equipment are situated, of 100 million and below. So dapat the total asset of a corporation excluding property, plant, and equipment should be 100 million and below. Take note, 100 million and below. That's the first requirement. Second requirement, that the corporation should have a net taxable income of 5 million and below. So if a corporation does not comply, cannot comply 1 and 2 requirement, that's the time it will be subject to 25% RCIT. So 25% RCIT are for those other corporations, and with the condition that with 1 year deduction until 2027 to bring the rate to 20%. Okay? So every year, the corporation will be, the rate of RCIT for other corporations will be reduced to 1%. Like for example, on year 2021, the first year of operation of other corporations under this requirement, so the corporation will be liable to pay 25% RCIT. Next year, it will be reduced to 1%. So that corporation on its second year of operation, it will be liable to pay 24% RCIT. Then the next year, it will be 20% RCIT. Then the following year, it will be 22% RCIT. Then on the next year, it will be 21% RCIT. And lastly, on the fifth year of operation, it will be subject to 20% RCIT because the requirement is a reduction of 1% every year to bring the rate to 20%. Okay? To bring the rate to 20%. And this rule is until year 2027 only. Because after that, it will be another law will take place, or the implementation or the effectivity of great law will no longer applies beyond till year 2027. Okay. So next, on the first 3 years, 3 year of operation, the corporation is liable for RCIT. Okay, so on the first 3 years of the corporation, first 3 year of operation, so the corporation will only liable for RCIT. Okay, RCIT lang. But beginning with the fourth year of operation, from the start of operation, on the fourth year, the corporation will be liable for RCIT or MCIT, whichever is higher. Take note, guys, upon the creation of a corporation on the first year of operation up to the third year, the law requires the corporation to pay only RCIT because the tax base of RCIT is taxable income. So it is allowed, or it is perceived that on the first 3 years of operation of a newly created corporation, it will possibly suffer losses. So if it is possible to suffer losses on the first 3 years of operation, therefore, that particular corporation will no longer pay taxes to the government. Why? Because the RCIT is computed on the taxable income. So if the corporation suffer losses, the taxable income would be zero. So therefore, multiply your 20% RCIT, your tax due will be zero. Unlike on the fourth year of operation, you have minimum corporate income tax. So the tax base of your minimum corporate income tax is based on gross income. Okay? So it is your income before the deduction of your business expenses. So therefore, there is a figure or a positive or an amount that would result to the computation of your MCIT based on your gross income. Okay, so next illustration for regular corporate income tax. YCO Corporation, a domestic corporation, had the following information. First, we have your net sales, 2 million, and cost of sales, 500,000. Then business expenses and losses, or it is called as itemized deduction because we have already discussed chapter 4. So business expenses and losses or itemized deduction in the amount of 500,000. And capital gains on land sold for 5 million. The gain is 900,000. Then we have your interest on Philippine deposits, 20,000. So we are asked to compute for the regular corporate income tax or RCIT. So the computation would be, we have your net sales, 2 million, less your cost of sales, 500,000. That gives us the gross income from business in the amount of 1,500,000 less your itemized deduction or business expenses and the amount of 500,000. So the difference would be taxable income, 1 million. Multiply by 25% RCIT. So your tax due would be 250,000. So that is the RCIT of Y Corporation. Okay, next. We have your minimum corporate income tax or MCIT. Okay? So, gross income subject to MCIT. Okay? So, your MCIT is 1% of the minimum corporate income tax gross income. So, beginning with the 4th year of operation, so the gross income subject to MCIT, the formula would be gross income subject to MCIT multiplied by 1%. Okay? So, what is the gross income subject to MCIT? So, this pertains to gross income not including capital gains, which is subject to capital gains tax and passive income with final tax. So you have to exclude your capital gains, which is already subjected to capital gains tax, and any passive income, which has subjected to final tax on passive income. Second, gross income will include all income earned or realized during the taxable year. That is subject to normal tax. Okay? So, including gross income derived outside of the main activities of the taxpayer. Okay? So, the tax base for MCIT would, or the gross income for MCIT would be the same gross income which is subject to your RCIT. So, that is according to Revenue Regulation number 12-2007. Okay? So that would be the composition of the gross income subject to MCIT. Next. So we have what we call the excess of MCIT over RCIT of a year. Of a year will be carried forward and credited against the regular tax for the 3 immediately succeeding taxable years. Okay, so the excess of MCIT over RCIT of a year will be carried forward and credited against the regular tax. Lipat ko. Sino? Nagpalawag na? Nanawag sila na? Sa GC? Pero nadunduan mo na ako. Okay. So the excess of MCIT over RCIT of the year will be carried forward against and credited against the regular tax for the 3 immediately succeeding taxable years. Okay? So when what we call excess of MCIT is therefore your MCIT would be greater or higher than your RCIT. So the difference will be carried over for the next 3 years and it is allowed to be credited against the regular tax. So we will explain that more or in detail when we reach the illustration regarding excess of MCIT. Okay, so first let's discuss a sample problem for minimum corporate income tax. So YCO, a domestic corporation, in its 4th year of operation had the following. Net sales, 2 million. Cost of sales, 500,000. Business expenses and losses, 500,000. Capital gains on land sold for 5,900,000. Interest on Philippine deposit, 20,000. Okay, so the computation of your NCIT is, we have your net sales, 2 million. So in the case of service provider or seller of services, the term should be gross receipts. So net sales 2 million. Last, cost of sales or direct cost of service in case of seller of services, 500,000. So the difference of these two figure will be your gross income subject to MCIT. That's 1,500,000. Multiply it by 1%. So the computed MCIT would be 15,000. Okay, so gross income exclude capital gains, which is 900,000. As you can see, this figure is not included in the computation because it is already subject to capital gains tax. Then and on the gross income, it exclude as well the passive income subject to final tax of 20,000 because it is already subject to final tax. So the rationale of not including these two figures because is it is already subject to another tax. One is capital gains tax and this one is subject to final tax on passive income. Okay, so next illustration of RCIT versus MCIT. Zenas Incorporated had a gross profit from sales of 800,000 and a gain on sale of an asset of 190,000. Business expenses were 940,000. How much was the income tax for the year if it is in the fifth year of operation? So the computation would be gross profit from sales, that 800,000. Take note guys, the figure provided by the problem is already gross profit. So that is the difference or the result of your net sale less cost of sale. Please take note. So gross profit of 800,000, then add gain on sale on sale of asset of 190. In the computation, we included 190, which is gain on sale of an asset, because there's no clear indication that this particular transaction is already subject to capital gains tax because it is not provided what kind of asset being sold. So for the benefit of the doubt, it would be given in favor of the government. So wala iya ginhambal guys nga lote or real property na siya. And why man ginhambal that this figure is already subject to capital gains tax. So therefore, we have to include that in our computation. So the total gross income is 990,000 less the itemized deduction, and the amount is 940,000. So the difference is your taxable income in the amount of 50,000. So let's compute RCIT and MCIT. As I mentioned earlier, your MCIT and RCIT are partners in crime. So you have to compute both taxes in a particular taxable year. Okay? So RCIT, that's 50,000 multiplied by 25%. So the RCIT would be 12,500. Then your MCIT would be 990,000 multiplied by 1%. That's 9,900. So the income tax due, whichever is higher, would be, the income tax due would be the higher between RCIT and MCIT. So in our case, that's 12,500. So gross income will include all income earned or realized during the taxable year that is subject to normal tax. So including gross income derived from outside of the main activities of the taxpayer under Revenue Regulation number 12-2007. So all income earned by the business, whether it is derived on the main activity or not, as long as it is not yet subject to any taxes, you will include that in the computation of your RCIT or MCIT. Okay, next. So illustration for the excess of MCIT over RCIT carry forward. So please take note guys on our illustration, year 1 to year 3, your MCIT is not applicable because MCIT is not applicable on the first 3 year of operation of our company. The rationale is that uh, the corporation is given a 3 year allowance to realize income or to realize profit. So if ever that the corporation is suffered losses for the first 3 years, so take note your RCIT, the tax base of it is the taxable income. So in case of losses, there's the RCIT would be zero. Okay? So that's why MCIT is not yet applied or implemented on the first 3 years, 3 year of operation of our corporate taxpayer. So your MCIT would be effective or applicable on the year 4 onward. Okay, so going back in our illustration, so year 1 to year 3, 10,000, the RCIT. So that would be the tax due for year 1 to year 3. So, ging sum up ko lang guys for illustration purpose. Okay, so we will focus on year 5 up to year 8. So on year 4, the computed MCIT is 80,000. Then the computed RCIT is 20,000. So as you can see, RCIT is lower than the MCIT. So for tax due, of course, there's no question. Whichever is higher between your MCIT and RCIT would be your tax due. Okay? But because MCIT is higher than RCIT, it will generate what we call excess of MCIT. So excess of MCIT. So in our case, that is 60,000. So your excess of MCIT in accounting terms, it is referred as deferred taxes. So the account title for excess of MCIT would be deferred taxes. So that's 60,000. So on year 4, we have a deferred taxes of 60,000. When we say deferred taxes, we have already paid that amount or that kind of expenses, but it is not yet incurred. Okay? On year number 5, the MCIT is still higher than the RCIT. So on year number 5, we have also realized excess of the MCIT in the amount of 20,000. So that is the difference between 50 and 30. For year number 5, there's no question that the tax due would be the highest between MCIT or RCIT. So in our case, on year 5, your MCIT is higher than the RCIT. So therefore, that 50,000 is the tax due for year number 5. Okay. So for year number 6, as you can see in our illustration, RCIT is 40,000 while your MCIT is 30. So therefore, your tax due would be your RCIT. Okay? But on previous period, we have realized excess of MCIT. On year number 4, we have realized 60, remember? And on year number 5, we have a resulted excess of MCIT in the amount of 20. So the rule is, the excess of MCIT is credited against the regular or normal tax. Okay? So the excess of MCIT over RCIT of a year will be carried forward and credited against the regular tax. Okay? So we are allowed to use your MCIT to reduce the amount of taxes to be paid on that particular year. Okay? So let's go back to our illustration. Okay. So as you can see, on year number 6, we have used your excess of MCIT on year number 4 to reduce the tax payment or tax to be paid on year 6. So the tax due is 0. Okay? On year number 6, there's no tax payable that the company will pay on year 6. Okay. So continue. On year 7, MCIT is higher than your RCIT. So again, on year 7, we have realized an excess of MCIT in the amount of 20,000. So of course, for tax due purposes, the corporation will pay the higher amount between MCIT or RCIT. So as you can see, it is your MCIT. So the tax due would be 40,000 for year number 7. On year number 8, as you can see, RCIT is higher than the computed MCIT. Okay? So, of course, for tax due, your RCIT would be the amount that the company will pay for year 8. But, again, we have realized deferred taxes or excess of MCIT in prior periods. So, we are allowed to use those excess of MCIT carried forward on the previous years. Okay, so let's uh, check if there are remaining MCIT earned during year number 4. Okay, so we have 60,000 earned or realized during year 4. But out of 60,000, 40,000 was used to credit or to reduce year 6. Okay? So in short, the difference is, or the unused portion of your 60,000 MCIT is 20,000. But the question is, can we still forward that unused portion of your excess of MCIT on year 4 to be credited on the tax payment or tax due on year 8? So the question is no. Why? Because under the law, the excess of MCIT can be carried forward on the 3 succeeding years. So it was earned in year 4, so the 3 succeeding years would be year 5, year 6, and year 7. 1, 2, and 3. So therefore, on year 8, it is already expired. Okay? So you are not allowed to use the remaining 20,000 excess of MCIT for year number 4. Okay? You are not allowed to use the remaining or the unused portion of 20,000 to be credited on year number 8, okay, because it was already expired. Okay, but we still have an excess of MCIT from other year. So for year 5, we have also realized excess of MCIT. Remember, that's 50,000 minus 30,000. We have realized 20. So 1, 2, and 3. So we can still apply the excess of MCIT on year number 5 to be credited our regular tax on year number 8. Okay? And still, 70 minus 20, we still have to pay 50,000. But again, on year number 7, we have earned or realized excess of MCIT, which is 40,000 minus 20,000. So the difference is 20. So the excess of 20,000 MCIT realized on year 7 is credited on year 8 because it is still within the 3-year period to be carried forward. Okay? So of course, what the corporation will pay on year number 8 is only 70,000 minus the excess of MCIT on year 5 minus excess of MCIT on year 7. So the difference would be 30,000. So the amount of 30,000 is the amount that the corporation will pay uh, to the government. Okay. So excess of MCIT of 60,000 of year 4, recap, 80 minus 20 could be carried over up to year 7 only. Year 7 only. So 1, 2, and 3. Year 7. So the unused excess of MCIT of 20,000, which is computed using 60, additional 60, minus 40,000, which is used on year 6. So the unused portion in year 6 could no longer be used in year 8 because it is beyond the 3-year period of MCIT that can be carried over. Okay? So that is how we apply the difference of MCIT over RCIT. Okay? So, forward. Next, we have optional gross income tax. So, conditions. Since when we, the term optional, it means there's an option for a corporation to apply 15% gross income tax. So, in what scenario? So, the president can only declare or may allow, only the president of the Philippines may allow a corporation or corporations upon the satisfaction of certain conditions. So, there's a condition provided by the law to be taxed a 15% gross income. Okay, 15% gross income. So what are the conditions? First, a ratio of 40% of income tax collection, this is on the part of the government, to account for that income tax collection of the Bureau of Internal Revenue and other collecting agencies versus or over the total tax revenues. So dapat sa total tax revenues collected by the government, 40% of the tax collection should form part or should compose the income tax collection. Okay? Income tax collection. Okay? Next, that is the first condition. The second condition, it is available to firm only with a ratio of cost of sales to total sales or revenues that should not exceed 55%. So therefore, if you are allowed to use optional standard deduction, you have to make sure that you have a gross profit of 45%. Gross profit rate of 45%. Third, the election of gross income tax option by the corporation will be irrevocable for 3 consecutive taxable year during the corporation's qualified under the scheme. Okay, so 3 consecutive year that the corporation cannot has no choice but to use the 15% gross income tax. So, when the corporation qualifies to avail the 15% gross income tax, so of course, the corporation will no longer liable to pay MCIT or RCIT. Okay, illustration. Optional gross income tax or GIT. So sales given, that's 1 million, less cost of sales, 400,000. Then the difference is your gross income, 600,000, less itemized deduction of 200,000, then the difference would be taxable income. So your GIT would be 600,000 times 15%. Ano siya? So gross income times the GIT rate of 15%, so the gross income tax would be 90,000. So as you can see guys, the ratio of cost of sales to sales is 40%. So what the law provides that the qualifying corporation should not exceed 55%. So in our illustration, the corporation is availed or allowed to use GIT since its gross cost of goods sold rate over total sales or total revenue is only 40%. Okay. So guys, let's ano lang, for curiosity purposes, let's compare what if the corporation will just maintain its regular corporate income tax or normal tax. So what would be the tax that the corporation would pay? So it is 400,000 times the 25% RCIT. So the result will be 900,000. So in our case, it is a case-to-case basis, guys. In our case, it is advantageous for our corporate taxpayer to avail GIT if the condition is met. Okay? So the ratio of cost of sale to sales, which is 40%, does not exceed the 55% condition. Thus, the corporation is allowed to select GIT. Okay? So normal tax is completely disregarded if the corporation is allowed to select GIT. Okay, next, we have your quarterly tax on corporation. So within 60 days after the end of each of the first 3 quarters of the year, a corporation files an income tax return. So that is BIR Form 1702 on or before the 15th day of the 4th month following the close of the taxable year. So that would be April 15 of the following year. April 15 of the following year. So a final or annual income tax return is filed. So the quarterly and final income tax return are summary declaration of gross income and deductions on a cumulative basis. So deductions are the itemized deduction for expenses and losses. So we have already discussed that on our previous videos. Kindly review. The normal income tax and minimum corporate income tax are computed on a quarterly basis. So you still have to compute MCIT or RCIT even though the tax return is a BIR Form 1701Q or quarter. And as well in the final income tax return or in the BIR Form 1702. So whichever is higher is paid. So the same in our discussion earlier. Whichever is higher, that would be the taxes that the corporation will pay. So the higher between RCIT and MCIT. So the tax computed on the quarterly or year-end taxable income is decreased by the amount of tax paid for the preceding quarters or quarters. There may be income tax payable, but there is no tax refundable. Take note guys, but there is no refundable in a quarterly return. There is no tax refund in a quarterly return. Please take note. Okay. So if the sum of the quarterly tax payments made during the year is lesser than the total tax due on the final tax return, so it means that you have paid on your first, second, and third quarter more than the amount that you should pay on an annual basis. What would happen? The corporation will have an income tax still due, but if more than the taxes in the three quarter or tax return, there may be a minimum